The loss of $1 trillion from the American market is an event that would send shockwaves through the financial world, leaving not just investors and financial experts scrambling to understand the cause, but also affecting countless individuals across the globe. Let's take a journey through a fictional scenario where such a massive loss occurs, how it happens, and what it means for the economy and the future. It all began on a seemingly typical Monday morning, when news started to spread across financial platforms that a major American corporation, let's call it GlobalTech, had experienced a catastrophic series of failures. These failures were not caused by a single event, but by a series of escalating issues. It all started with a major cybersecurity breach, where hackers infiltrated GlobalTech's systems and stole sensitive data. The breach wasn't just a minor incident. It was so massive in scale that it compromised the security of millions of users' personal and financial data, shaking the trust consumers had in the company. Initially, the breach seemed like a temporary setback. GlobalTech's executives reassured the public that they were taking swift action to contain the damage. But over the following weeks, it became clear that the situation was far worse than anyone had anticipated. Not only was the company's reputation tarnished, but the breach also led to a series of lawsuits and regulatory scrutiny. The company's stock, which had once been one of the most valuable in the world, began to plummet. But the story didn't end there. As GlobalTech's stock continued its downward spiral, the news broke that the company had also been involved in an insider trading scandal. Key executives were implicated in using confidential information to make personal gains, which only deepened the public's distrust. Investors began to pull their money out of the company, and as the stock price continued to plummet, panic set in. The loss of confidence in GlobalTech quickly spread to other tech giants and industries closely tied to the company. It was a classic case of a domino effect. Companies that relied on GlobalTech's products and services found themselves facing operational disruptions, and the broader tech market began to crumble. Investors who had once viewed the tech sector as a stable, growth-driven industry suddenly saw their portfolios shrinking, and with each passing day, the numbers became harder to ignore. On Wall Street, financial analysts began to warn that the loss of $1 trillion in market value was no longer just a possibility, it was becoming an inevitability. Hedge funds, mutual funds, and institutional investors began to sell off their positions in tech stocks, further accelerating the downturn. The once booming American tech market had been brought to its knees by a combination of poor management, lack of foresight, and a series of scandals that rocked the very foundation of the industry. As the loss reached $1 trillion, the impact was felt far and wide. Pension funds that had invested heavily in the tech sector were now facing huge deficits, and millions of Americans who had hoped to retire comfortably were suddenly facing a much bleaker financial future. For many small investors, the loss was devastating. They had trusted the growth of the tech industry to provide them with long-term financial security, but now they found themselves wondering how they would recover. The ripple effects were felt globally as well. Countries that had close economic ties to the U.S. economy watched in horror as their own stock markets followed the American downturn. Even international companies that had been profiting from their partnerships with GlobalTech and other American tech companies found themselves scrambling to adjust to the new reality. In Washington, the government was forced to step in. Federal regulators began looking into the causes of the crisis, questioning whether it was preventable and whether the regulatory framework in place had been sufficient. Other companies appeared that were getting ready to reopen. The public demanded accountability, and many politicians called for stricter regulations on corporate behavior, particularly in the tech sector. But the political fallout wasn't just about regulation. The crisis prompted a national conversation about the future of the American economy. Was the tech sector too dominant? Were other industries being neglected in favor of tech growth? And most importantly, what did this massive loss mean for the average American? As the economy struggled to recover, there were some glimmers of hope. smaller companies began to emerge as potential disruptors, challenging the old guard of the tech industry. Investors began looking for new opportunities, and slowly, the American market started to rebuild itself. However, the lessons from the loss of $1 trillion were not easily forgotten. In the years that followed, the tech sector was forced to adopt more rigorous oversight, with new laws in place to protect consumers and investors alike. And while the market did eventually recover, the damage to the reputation of American corporations was long-lasting. People began to question the priorities of big business, and whether the pursuit of profit should always come at the expense of trust and transparency. The story of the $1 trillion loss was a cautionary tale. It was a reminder that even the most powerful and seemingly invincible companies could fall, and that the financial stability of an entire nation could be disrupted by a series of poor decisions. It was a moment in history that would be remembered for generations as a turning point that forever changed the way people viewed corporate power, financial markets, and the role of technology in shaping the future. And she didn't understand why this uneasiness was building inside her body.